Going into this morning, the consensus on Wall Street was grim. GDP was expected to print at 1.6%, the same weak number we saw last quarter. Core PCE was forecast to tick higher. Unemployment claims were trending up. Every major bank had some version of the same story. The economy is slowing, inflation isn't going away fast enough, and the Fed is trapped. Stagflation was the word. Slow growth, sticky prices, the worst of both worlds. And then 5:30 this morning hit. GDP came in at 2.1%, not 1.6%, not even 1.8%, 2.1%, a 31% beat over what economists were calling for. Core PCE held in line at 0.3%, exactly at forecast. Not reaccelerating, not cooling, just controlled. Unemployment claims dropped to $215,000, 10,000 fewer than expected. Personal income surged 0.7% against a forecast of 0.4%. Core durable goods orders came in at 1.3%, more than double the 0.5% consensus. In one morning, nearly every major economic fear that has been hanging over this market got answered. And I want to walk you through exactly what this means. For the macro picture, for rate cut expectations, and most importantly, for what the ICC system was already telling us before a single number dropped. Let's start with GDP, because this is the number that matters most. Final GDP for Q1 2026 came in at 2.1%. The market was bracing for 1.6%. That's not a small miss. That's economists being wrong by nearly a third. Why does this matter? Because GDP at 2.1% tells you the recession fear that has been priced into everything. The defensive rotation, the safe haven gold bids, the rate cut expectations. That fear was built on a foundation that turned out to be wrong. The US economy isn't stalling. It isn't stagflating. It is growing at a pace that would have seemed perfectly healthy in any other environment. Now, here's where it gets nuanced. The GDP price index came in at 3.6% against a forecast of 3.5%. That's a slight overshoot on embedded inflation within growth. So the growth is real, but it's not completely clean. The Fed doesn't have a free pass here. But, and this is the key, core PCE held at exactly 0.3%. That's the Fed's preferred inflation gauge. It didn't reaccelerate. It didn't print hot. It came in exactly where the forecast said it would, which is actually the most bullish possible outcome when you pair it with a GDP beat. Strong growth. Controlled inflation. That is not a stagflation print. That is a resilient economy print. Now let's talk about the labor market, because claims at 215,000 deserve a full stop. The forecast was 225,000. The prior reading was 227,000. We printed 215,000. 10,000 fewer people filed for unemployment this week than the market expected. In an environment where traders have been watching every labor print for signs of cracks, $215,000 is a signal that the employment picture hasn't broken. And then personal income, 0.7%. The forecast was 0.4%. The prior was 0.0%. Think about what that means. Last month, personal income was flat. This month, it surged 0.7%. That's not a consumer who is running out of runway. That's a consumer who just got paid. Personal spending followed at 0.7% versus a 0.6% forecast. Income is up, spending is up, and claims are falling. This is the opposite of a recession setup. Core durable goods at 1.3% versus 0.5% forecast tells you business investment is still moving. Companies aren't pulling back. They're buying equipment, committing capital, betting on the next quarter. Every data point this morning pointed in the same direction. The economy is more resilient than the fear suggested. So what does this mean for the Fed? Here's the honest answer. It complicates the rate cut narrative, but not in the way most traders think. Before this morning, the consensus was that weak growth would force the Fed's hand, that they'd have to cut to avoid a hard landing. That argument just got weaker. You don't cut aggressively into a 2.1% GDP print with claims at 215K. But PCE at 0.3% in line means inflation isn't reaccelerating either. The Fed isn't being forced to hike. They're not trapped between cutting and fighting inflation. They're actually in a rare position of patience. The economy doesn't need emergency intervention in either direction. What that means for futures traders is that the rate cut timeline gets pushed, but it doesn't disappear. And in the meantime, the growth data supports equity structure. A strong economy with controlled inflation is, historically, the most constructive backdrop for equities you can have. Now here's what I really want to show you, because all of that macro context matters. But what actually drives how I trade is the system. Before this morning's data, before the GDP print, before any of these numbers came out, the ICC system was already reading the market structure, and I want to walk you through exactly what it's saying right now on the MES, the MNQ, and gold. Because it's not just one signal, it's a multi-timeframe picture, and what it shows this morning is a masterclass in how the system handles a big data day. Let's start with the MES, Micro E-mini S&P 500 futures, on the daily chart. The daily is reading bullish indication phase. Structure shows transition bull. MTF alignment confirmed at 240, MTF strength 50% rated strong. The system fired a bullish indication at 7,043. That's phase 1 of the sequence. Correction is pending. Bull bias locked in at the macro level. Now watch what happens when you drop to the 1-hour chart. This is where it gets interesting. On the MS 1 hour, the system is reading something completely different. Bearish indication. Structure reads bearish authority. 100 out of 100 on the structural score at the 1-hour level. The system fired a bear indication at 7,513. Intraday correction is pending. So what is the system telling you? The daily is bullish. That's the macro trend, intact. But the 1 hour is saying this morning's GDP-driven pop to 7513 created a structural bearish indication at the intraday level. A correction at the 1 hour is coming before the intraday can continue. Current price at 7,485 has already moved below that indication level. This is not a contradiction. This is exactly how multi-timeframe analysis is supposed to work. Daily bias, bull. Intraday structure, flagging the pullback. The system holds both reads simultaneously without blinking. Now the MNQ, Nasdaq 100 futures, up 2.2% this morning. On the daily chart, structure reads bullish authority. 100 out of 100. Maximum structural conviction at the macro level. VRM trend. Bullish. Long auth confirmed. The swing and internal both read bull bias. Drop to the MNQ 1 hour. Same picture as MS bearish indication. Transition bear structure at 90. Bear indication fired at 30,336. Correction pending. Authorization blocked at the 1 hour level. The system isn't confused by the 2.2% GDP rally. It caught the intraday high and is now marking the potential correction sequence at the 1 hour level. The daily structural bull trend is fully intact above it. That's the precision of indication, correction, continuation, applied simultaneously across timeframes in both directions, without contradiction. Now let's look at gold, because MGC tells a completely different story. Gold is trading at 4,036 today. The 52-week high for this contract was 5,666. That's a 28% structural decline from the highs. And the ICC system has been reading this the entire way down. The daily structure on MGC reads bearish authority. 100 out of 100. Maximum bearish conviction at the macro level. MTF strength at 25%, rated weak. VRM trend bearish. MTF 240 bullish, but that's a short-term countermove within a structural downtrend. The system is in the bearish indication phase. Bear indication fired at 4,100. Short auth is active. A trail stop is running at 4,326. The correction on gold is pending, meaning if gold bounces toward 4,686, that's the correction phase. When that correction completes, the continuation short entry gets authorized. The swing reads bear trend. The internal reads bear trend. Both sides of the structural analysis are aligned bearish. Despite today's minor 0.69% bounce, gold is trading well below its own indication level. The news this morning described it as gold lingering near a 7-month low as Fed hike bets boost the dollar. Strong GDP at 2.1%. Claims at 215K. Personal income surging. The Fed has no reason to cut aggressively into this data. And the rate cut premium that had been propping gold up is dissolving. The system read the structural breakdown in gold before this morning's macro data confirmed it. The bear indication fired at 4,100. The trail stop has been running. The structure has been aligned. Today's data was the confirmation, not the setup. Here's the lesson I want to leave you with. Every single person watching the economic calendar this morning had access to the same forecasts. 1.6% GDP, 0.3% PCE. 25K claims. Every retail trader, every fund manager, every analyst, same numbers. And most of them built a narrative around those forecasts. Stagflation. Weak growth. Rate cut delays. Defensive positioning into gold. Then the actual data came in and the narrative broke. GDP 2.1%. Claims 215K. Income 0.7%. The traders who got hurt this morning were the ones trading the narrative. The traders who were positioned right were the ones reading structure through a system, not predicting what an economic report was going to print. The ICC system on the MES and MNQ was showing bull bias and bullish authority before a single number dropped this morning. On gold, it was running a short active trail stop with bearish authority at 100 and a bearish indication in place. The system didn't need to predict the GDP number. It was reading what the market was already telling it through price structure, multi-timeframe alignment, and the indication correction continuation sequence. Today's data wasn't a surprise to the system. It was a confirmation. If you want to trade with structure instead of noise, everything you need is linked in the description below. Subscribe so you don't miss tomorrow's session, because as long as data keeps moving like this, we're going to have a lot to work through together. I'm Liam, Trade Disciplined.